Hey everyone, UiPath stock is down 69% off its high. That's even after the surge it experienced in 2023. So is the stock a buy heading into 2024? That's the question I'm going to answer in this video, looking at the progress UiPath made in 2023, looking back a little bit longer term at some of its critical financial metrics, checking out its balance sheet, and finally weighing it all together against its valuation to determine if I think UiPath stock is a buy for 2024. So let's get right into the details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So UiPath had one of the best performing 2023 fiscal years over a lot of the companies that I follow because of how it achieved these results. Now, going into 2023, UiPath experienced a major slowdown in the business in late 2022. So management made some adjustments. It streamlined some costs and it really paid off in 2023. Let me show you how. So if you look at revenue, and let's look at the 9 months which ended October 31st here. Revenue increased to 902.8 million, up from 750 million. However, the total cost of revenue did not increase by all that much. It increased to 142 million, up from 132 million. So while revenue increased by 150 million, the total cost of revenue only increased by 10 million. That was due to a lot of the streamlining, the efficiency improvements that management made late in 2022 when the company really faced a significant slowdown. Let's look further. Sales and marketing expense actually decreased year over year to 521 million, down from 527 million. I'm always impressed when a company can grow revenue by as much as UiPath has done in 2023 by more than 150 million, or roughly 20% from the 9 months ended last year. And they did this all while decreasing sales and marketing expense. That's impressive because remember, you can always increase revenue by increasing your promotional spending, right? If you offer discounts, incentives, promotions, rebates, and things like that to your customers, you're going to increase sales. But that's coming at the cost of your bottom line. UiPath increased sales while decreasing promotions. I was impressed with that. And the area where they increased spending is what I like to see with tech companies, especially research and development going from 203 million to 246 million. And general and administrative expenses falling from 189 million to 172 million. So these are all things that I like to see. I love to see companies shrink their general and administrative costs. These are things like salaries for the CEO, CFO, senior management. These are things like office expenses, perks for management, and things like that. Things that, in my opinion, are there's a lot of corporate waste in there. And I like to see them shrink some of that corporate waste. And I'm liking what I'm seeing from UiPath. Overall, from top to bottom, in the 9 months that ended 2023, I liked everything I saw from UiPath, and the company deserved the stock price increase that it experienced as of recent months. So they've done a good job in managing the company, in managing the slowdown they experienced in 2022, and that's leading to a nice rebound here in 2023. I mentioned they experienced the slowdown, and you can see this here in late 2022, but this is a cyclical business, right? You've seen the ups and, a seasonal business, and you've seen those down times following the end of the year. And UiPath did a good job in rebounding and recovering from that. Now its revenue growth is actually accelerating. It's actually accelerating. And that's another good sign for UiPath stock investors, is that not only is the company growing revenue, but it's growing the rate of growth, right? That's the second derivative. The first derivative is the growth rate. The second one is the rate of the growth rate. And so that second derivative increasing, investors love to see that. That's a great sign for longer term prospects in companies. The next thing I wanted to highlight is UiPath is now firmly in the positive in terms of cash flow from operations. So you've had 1, 2, 3 consecutive quarters where the company's generated positive cash flow from operations. 41.85 million in the most recent quarter, and a few quarters of positive cash flow from operations. And this is, I think, enough where investors can feel confident that the company has turned the corner now and will be positive cash flow from operations going forward. Although it's a little too early to say definitely yes, this is going to be the case, but 3 quarters of meaningfully positive cash flow from operations, I think, and given the improvements I see in the company's income statement, I think for me, I can say with a good probability that the company has turned the corner now and is self-funding, self-sustaining. And that's always good news because now they no longer have to come back to investors and say, we need more money. They don't have to. And that significantly lowers their cost of capital because they can still go to investors and borrow money or raise capital, but they'll be able to do it at such a lower rate because they don't need it, right? When you go to investors and you're desperate and you really need the money, it's really expensive. They'll charge you an arm and a leg for that capital. But if you're comfortably positive and you've got a strong balance sheet and you don't need the money, you can borrow money and raise capital at lower cost, which can then fund growth opportunities instead of just funding survival. So this is important, this is crucial, and it's great news that UiPath has achieved this. And we're seeing improvement in UiPath's operating profit margin as well, notably from the improvements the company made. Like I mentioned, you can see going from negative 55-60% in operating profit margin all the way up to negative 18.57%. So while it is positive in cash flow from operations, it's still losing money on the bottom line. And you might ask, how is that the case? Well, companies like UiPath use non-cash expenses like stock-based compensation. When they award their employees stock grants or stock options, they have to account for that as operating expense. But that's not a cash outflow, right? When you grant an employee a stock option, you're not giving them cash. And so it is an expense, but it's not a cash expense. And so that's why you have a difference between cash flow from operations and operating profitability. UiPath, looking at their balance sheet, you can see a pristine balance sheet with $1.8 billion in cash and short-term investment and zero debt. The balance sheet is in excellent condition, and now with positive cash flow from operations, that's even stronger. So the company's financial risks are de minimis because of its strong balance sheet and now positive cash flow from operations. So I wanted to also look at its valuation, and it's trading at a price to free cash flow of 61. 61 is on the expensive side for price to free cash flow, but the company has demonstrated strong progress. Let's look at what the estimates are for the next 2 fiscal years for UiPath. So according to the consensus of analysts that are following UiPath, they expect its revenue to grow by 19% in 2024 and its earnings per share to grow by 11%. They expect that to accelerate in terms of profitability, with revenue growing 18% in 2025 and earnings per share growing by 29%. So analysts expect revenue of 1.5 billion in 2024 and 1.8 billion in 2026, with earnings per share coming in at 53 cents in 2024 and 68 cents in 2025. That will mean that the company will be profitable on the bottom line with a net profit margin of 20% in 2024 and 22% in 2025. The prospects look good for UiPath and its growth over the next couple of years. That being said, a price to free cash flow of 61 is still a bit too expensive for me to recommend UiPath stock as a buy. I think it's right on the borderline. I've really liked what I've seen from UiPath in 2023. I think it's almost there. If it was trading at a price to free cash flow of 50 or below, I would have recommended the stock as a buy. But at 61, I have it right on the borderline. So if the valuation was to decrease down to a price to free cash flow of 50, I see myself upgrading this stock. So if that happens anytime soon, I will upgrade UiPath stock. Or if the company delivers better than expected revenue, profit, and cash flow in the next quarter, I can see myself upgrading UiPath stock as well. But right now, I have it right on the borderline. Like I mentioned, excellent performance, great management improvement from 2022 to 2023. I like the cutting costs of general and admin and sales and marketing while increasing spending on research and development. I like a lot of the stuff I'm seeing. It's just the price to free cash flow of 61 is a bit too rich for me. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.